Have you ever felt like the stock market is a roller coaster you just can't get off? One day you're up, the next you're down, and the constant stress of trying to time the market is just exhausting. What if I told you there's a simple, set-it-and-forget-it investment strategy designed to weather any economic storm? It's called the permanent portfolio, and it might just be the key to your financial peace of mind. This strategy was created by an investment advisor named Harry Brown back in the 1980s. He wanted to build a portfolio that would be safe and deliver positive returns no matter what the economy was doing, whether we're in a period of prosperity, a recession, inflation, or even deflation. Sounds too good to be true, right? Well, the concept is surprisingly simple and elegant. The permanent portfolio is built on just 4 equal parts, like 4 legs of a sturdy table. You allocate your investment capital into 4 25% slices. First up, 25% in stocks. This part is for growth. When the economy is booming and businesses are doing well, your stocks will do great. Think of this as your engine for prosperity. You can easily invest in this slice through a broad market index fund, like one that tracks the S&P 500. This gives you a piece of the action from the largest and most successful companies. Next, we have 25% in long-term government bonds. This is your safety net during a recession or deflation. When the economy slows down and interest rates fall, the value of these bonds tends to go up. They act as a counterbalance to your stocks, smoothing out the ride when the market gets bumpy. Think of them as the brakes that keep you from going too fast downhill. The third slice is 25% in gold. This is your protection against inflation. When the value of money goes down and prices for everything go up, gold has historically held its value or even increased. It's a tangible asset that can't be printed by a government, making it a reliable store of wealth during inflationary times. This is your portfolio's insurance policy against a devaluing dollar. And finally, the fourth slice, 25% in cash or short-term treasury bills. Cash is king, especially during a credit crunch or a deep recession. While it doesn't offer much growth, it provides stability and liquidity. When other assets are falling in value, your cash holds firm. It also gives you the dry powder to rebalance your portfolio or seize opportunities when other assets become cheap. This is your emergency fund, right inside your portfolio. So, let's recap. 25% stocks for growth, 25% bonds for recessions, 25% gold for inflation, and 25% cash for stability. Each asset class is chosen specifically to perform well in a particular economic condition. When one part of your portfolio is down, another part is likely to be up, creating a stable and resilient whole. Now, how do you manage this? It's incredibly simple. Once a year, you just rebalance. Let's say your stocks had a fantastic year and now make up 30% of your portfolio, while your bonds dipped to 20%. You would simply sell some of your winning stocks and buy more of the underperforming bonds to get everything back to that 25%, 25%, 25%, 25% split. This forces you to follow the golden rule of investing. Buy low and sell high, but without all the guesswork and emotional stress. The beauty of the permanent portfolio is its simplicity and its all-weather nature. It's not designed to hit home runs and make you a millionaire overnight. Instead, it's designed to consistently generate modest, positive returns while protecting you from major losses. It is a strategy for people who value a good night's sleep over the thrill of high-risk, high-reward gambles. It helps you build wealth slowly and steadily, decade after decade. So if you're tired of the market's wild swings and want a straightforward, logical approach to investing that you can stick with for the long haul, the permanent portfolio is definitely worth considering. It takes the emotion out of investing and puts a system in place that works for you, no matter what headlines are screaming on the news. Thanks for watching. If you found this helpful, give this video a thumbs up and consider subscribing for more simple financial strategies. Let me know in the comments if you've ever heard of the permanent portfolio or if you have any questions. See you in the next video.